EchoStar, ticker SATS, is a company that has undergone a major transformation in recent years, making it a stock worth analysing for long-term investors. Known historically for satellite communications and broadband services, EchoStar made a bold strategic shift in 2023 when it merged with Dish Network. This merger combined EchoStar's global satellite infrastructure with Dish's wireless spectrum assets, creating a stronger entity positioned at the intersection of satellite technology, broadband, and 5G wireless. Understanding EchoStar's investment case today requires digging into its fundamentals, cash flow health, growth strategy, competitive position, and the risks that come with such a high-stakes turnaround. From a fundamental standpoint, EchoStar is now a more complex business than it was prior to the Dish merger. The company historically relied on satellite broadband under its Hughes Network Systems division, which focused on providing connectivity to rural and underserved areas where fibre and cable options were limited. This segment generated consistent revenue, but was facing growth limitations as competition from fibre expansion and low Earth orbit satellite providers like Starlink increased. By combining with Dish, EchoStar now has access to a large pool of wireless spectrum assets and a significant subscriber base, allowing the company to pivot toward a broader telecom strategy. Revenue potential now extends beyond satellite broadband into mobile wireless services, enterprise connectivity, and integrated 5G offerings. Looking at the financial picture, EchoStar remains in a challenging phase. The company carries significant debt, inherited both from its own operations and from Dish. Servicing this debt will require disciplined cash flow management. On the positive side, EchoStar does generate steady revenue from Hughes broadband services and equipment, which provides a stable foundation. However, the integration with Dish adds both opportunities and risks. If the merged company can successfully monetize its wireless spectrum assets and grow its mobile business, free cash flow could improve significantly over the long term. In the near term, however, investors should expect volatility and potential negative cash flow as the company invests heavily in network expansion and integration costs. Cash flow is one of the key challenges facing EchoStar. Historically, Hughes operations generated modest but stable free cash flow, but Dish's wireless build-out has been cash-intensive. The combined company must now balance investing in growth with maintaining liquidity. EchoStar holds valuable spectrum assets that provide strategic optionality. They can be monetized through leasing, partnerships, or even outright sales if liquidity becomes strained. These assets act as a form of collateral that reduces insolvency risk, but debt repayment remains a pressing concern that limits flexibility in the short run. On the growth side, EchoStar is positioning itself to become a more direct competitor in both broadband and wireless. The company's satellite business still has relevance, particularly in rural areas where other providers struggle to reach. Hughes has contracts with enterprises, government agencies, and international customers, which provides diversified revenue. The wireless opportunity through Dish, however, is what makes SATS a potential turnaround play. Dish has long aspired to be the fourth major US wireless carrier, and with the integration into EchoStar, that vision is now housed under a single publicly traded entity. If EchoStar can execute on building out its wireless network, acquiring customers, and monetizing spectrum, the company could grow into a much larger and more valuable telecom competitor. Management quality is crucial in this story. Charlie Ergen, co-founder of Dish, continues to play a major leadership role at EchoStar. Ergen is known for making bold, contrarian bets, such as amassing wireless spectrum when most doubted its long-term value. This aggressive vision has given EchoStar significant assets, but execution risk is high. Investors must weigh Ergen's track record of opportunistic investing against the operational complexity of running a national wireless network. Confidence in management will play a large role in whether SATS stock attracts long-term believers or remains a speculative turnaround play. Technically, the stock has experienced volatility, reflecting the uncertainty around execution and debt. Shares of SATS have traded at depressed levels compared to historical highs, but the merger with Dish has introduced renewed investor interest. For technical traders, SATS remains a high beta stock with significant swings, making it more suitable for investors with higher risk tolerance. A sustained upward trend would likely depend on visible progress in network expansion, subscriber growth, and improved cash flow metrics. Peer comparison highlights EchoStar's unique position. On one side, it competes with traditional satellite broadband providers such as Viasat, and more recently with Starlink from SpaceX, which has disrupted the industry with its constellation of low Earth orbit satellites. On the other side, EchoStar, through Dish, competes with telecom giants AT&T, Verizon, and T-Mobile in wireless. This dual competition landscape is challenging, as EchoStar faces established players with far greater financial resources. However, its spectrum assets and satellite capabilities give it a differentiated value proposition, particularly in hybrid solutions that combine satellite and wireless coverage. The question is whether EchoStar can carve out enough market share in both broadband and wireless to achieve profitability. From a valuation standpoint, SATS trades at a level that reflects significant risk but also potential deep value. Investors who believe in the long-term wireless opportunity and the monetization of spectrum assets may see the current price as undervalued. A discounted cash flow model would be highly sensitive to assumptions about subscriber growth, ARPU, average revenue per user, and capital expenditures. If EchoStar executes successfully, the upside could be substantial, but failure to scale the wireless business could leave the company burdened with debt and underperforming assets. Risk factors are significant. High debt, execution challenges in building a national wireless network, and intense competition from better capitalized peers all weigh heavily on EchoStar's future. The satellite broadband segment faces increasing pressure from Starlink and other competitors, which could erode market share. Regulatory hurdles also remain a concern, as spectrum usage and telecom expansion often involve compliance challenges. In addition, capital markets may be less forgiving in the current interest rate environment, making refinancing debt more expensive. Despite these risks, the long-term thesis for EchoStar centers on its spectrum assets and the potential to build a fourth national wireless carrier in the United States. Investors who believe in management's ability to execute and who are willing to accept high short-term risk for potential long-term reward may find SATS an intriguing speculative play. For more conservative investors, the stock may appear too risky given the debt load and uncertainty around cash flow. In conclusion, EchoStar SATS represents a high-risk, high-reward opportunity. The merger with Dish has fundamentally reshaped the company, creating both significant challenges and new avenues for growth. The key variables to watch will be subscriber growth, network build-out progress, monetization of spectrum assets, and cash flow management. If EchoStar can navigate these hurdles, the upside could be substantial, potentially transforming the company into a true competitor in the US telecom space. If not, investors may see continued struggles and limited returns. For now, SATS remains best suited for speculative investors who can tolerate volatility and are willing to beat management's vision for the future.